This is Scott Becker with the Becker Private Equity and Business Minute podcast, and thank you for listening. There are really two stories that I'm following this morning closely I think are sort of fascinating. First is the economy revving at a faster pace than expected. It created more jobs, more inflation than expected, and this is leading investors to be very worried that the Fed is going to stay aggressive in rate raising. The Fed again meets March 20th and 21st, I believe. Clearly, they're expected to at least do 25 basis points in raising interest rates. They might do 50. This is causing concern to the market, and it leaves the markets relatively sort of flat until there's news that points to the Fed starting to find an equilibrium and starting to slow down on rate raising. The second story is unrelated but related. And this is a story reported in the Wall Street Journal that consumers are starting to default and be late on auto payments in the highest numbers in about 13 to 14 years, since about 2010. And this is concerning because this is something we all saw coming. And this is really concerning because so much of the economy is based on consumers driving the economy. Now, what's happened over the last couple of years is consumers have racked up the highest level of credit card debt. That's not even to mention car debt and home equity debt ever, and almost $1 trillion in credit card debt. That credit card debt, related to the first story, is now averaging 20% a year per annum in interest payments. And so, of course, this at some point leads consumers to be in a tough spot, because just like the government, just like a company that's got more and more debt at higher interest rates, they now are having a harder time making the rest of their budgets work. So you see sort of the highest point in late car payments in almost 13 years. You've also got a stat reported last week by the Wall Street Journal too, and a study by Goldman Sachs, that consumers are spending down their excess pandemic savings. So you've got this double whammy: greater credit card debt than ever before, plus consumers spending down what was their pandemic savings to put themselves in a more vulnerable or more fragile spot. And then you've got this triple whammy almost, of the Fed continuing to raise rates, which makes those credit card payments higher, more expensive. It also leaves the consumers more fragile if they lose jobs when they have more debt and higher interest rate payments. So a very interesting situation, a little frightening, quite frankly. The United States, just like China does, continues to print money, so sort of bails everybody out. But I don't know how long that can last. In any event, thank you for listening to the Becker Private Equity and Business Minute podcast, and thank you to Jeremy Core at Executive Podcast Solutions. Thank you very much.